Hey, good morning. Welcome back. Another live stream, 0xResearch on a Friday morning or afternoon or evening, depending on where you're at. Joined by my co-host, Triple Boccaccio, Pocket Boccaccio. How you doing, Buck?
I'm good, Danny. How you doing?
Doing pretty good. Markets are, as the title says,
Chop
City, turbulent seas. A select few assets are doing crazy run-ups, and while everything else chops. So it's kind of an interesting time.
Sorry, I'm trying to look at the market before I give any.
Before you say anything.
It's like the price is always the same, right? I checked 2 days ago and I only look at the hype and BTC price, and the hype price was 38. I think it's 40 now, and then like 4 days ago it was 42. So it's like there's not much. There's not a lot to go off of. It is Chop City, but there's also two tokens that I am sidelined into, one of them being Zcash, which I cannot bring myself in to buy. And when I do buy, I'll probably make a tweet on it so that people know to exit. And the other one is OR, another one of those tokens. This is the first token that Ian Unsworth, shout out my goat, bought. He bought
ever
the lows, huh?
First token he ever bought?
No, maybe. I don't know. I've never seen him shill a token to me. And it's the first time that he's ever shilled a token to me. Like, hey, man, OR's going to go up. I was like, no, stupid. And then it's ripped faces. It's up like 8x. It's ridiculous. The two like randomest tokens as well. Who's like, oh, yeah, I'm bidding OR again. Oh, I'm bidding Zcash again.
Well, I will, at least for OR, they made the classic rotation from sort of valueless thing to casino, and the market is re-rating it on the premise of casino.
This is I mean,
which we've seen from a few, like, I don't know. There's a lot of I guess what I would say, there's like some sentiment or there's a trend that's happening where some teams are, entering into ICOs, entering into launch pads, entering into casino, because that's like one of the few sort of revenue opportunities that are very clear in the space. But it's working out. It's working out for OR. I mean, Dan Smith's been posting the OR daily revenues at all-time highs for like the 15th day in the past month or something.
Let me see if I can find it. We have it in a dashboard. I know that.
It's almost as good as when he was posting Solana REV new all-time high every day for.
I think this one's a little bit better. The Solana REV one, like, it was like such a slow grind up, right? It's like over 2 years, like Solana, like, quote unquote, dies because of the FTX collapse, and then very slowly it upticks, like it never dies out really. And then like REV local tops, let's say, at the Trump thing, and he was posting off throughout that. But with OR, it was really funny because 1 week it's making zero money, the next week it's making like 300K a day, and then he just starts bull posting it. And again, huge shout out my goat Ian Unsworth, who actually surprisingly made a very good, not surprisingly, I don't want to be mean to him, but those are good calls.
Ian Unsworth and our very own Nick Carpenito on the analyst team.
Oh, yeah, that's true. I forgot. I told him not to write. I told him he wanted to write a research report. I was like, no, we're not doing that, buddy. It's dead. It died out, like, because OR died 3 times, right? It was like originally it killed Solana blockchain.
You didn't see the vision, man. They went to casino.
I didn't see the vision. I remember he brought it up to me. I was like, no, we're not doing this. He was right.
I'm actually not sure. I think he sold too early. If I'm if I'm not mistaken. So maybe it's working out better for Ian Unsworth.
Yeah. Well, let's not say Nick sold too early on the pot. I'm pretty sure he held it until the top. Whenever the top was, he will sell it there. Let's not make it a.
Let's tell people that he actually 10x'd his net worth, and now they should put a target on him, a very clear public target on him, rather than that he lost his money and is actually not worth going after.
We're getting very, very intense on it.
He doesn't have any money. Don't worry about him, chat.
Let's call him broke on the pod. But no, like, I mean, they died out 3 times. So they killed Solana the first time around. I remember the first time I was trying to mine it, and it was impossible to mine. And then the second time around, it did something new. I think it changed its inflation mechanics. Someone will correct me if I'm wrong somewhere. And then the third time is this time, I think. It's the gambling meta. And I think they finally hit it. I'm not sure how sustainable it will be again. But, I mean, it's been doing really well, so there's not much to... You can't really... I'm trying to pull up the thing still, but...
Yeah, I think... I guess maybe another thing we can talk about, not live yet, but interesting topic or point of discussion is we saw Keone come out and state that Monad locked tokens will not accrue or be eligible for staking rewards, which was a big problem for a lot of proof of stake networks over the past 4 or 5 years. Obviously, you get a lot of people upset on the timeline over the past few years from kind of TIA and various other like Cosmos chains that sort of had that model, maybe like unknowingly by the retail public, that they could have just been getting, been buying into not unlocking, but staking rewards from locked entities. So it's a good signal from them.
My hard take here is that this should have never even been a discussion. Like, this is a purely Cosmos thing. Sorry.
They're coming for you.
That's the Cosmos guys. They're coming for me.
That was Keone calling you right now.
Keone. Well, I'm not saying anything against Keone.
They're cutting your airdrop in half, actually, for this based on the statement.
I'm just... this should have never been a thing, right? This is like purely a Cosmos thing for some reason. Like, Cosmos chains have this... The way that Cosmos SDK works, I think it's pre-enabled such that stake tokens or lock tokens can earn rewards. I don't know why the Cosmos ecosystem decided that this was a good way to approach this. Maybe back in the day it wasn't as big of a deal. I don't know how many Cosmos chains raised significant amounts from VCs, so maybe like it was never a concern, but it became a huge thing with Celestia. I think, when did Celestia launch? 23? Yeah. 24. Let's say 24, just in case.
End of 23, but yeah.
Became a huge thing. I remember there was this like spreadsheet floating around, and it was one of the big arguments. Like, it ran up to 2022, right? I don't know what. I guess like, let's say that's like 22 billion FTV. And then like around 15, 16 billion, this spreadsheet came out, and it was like, oh, like Polychain is earning whatever amount, because the staking rate is also super high. It's like 12%. And if you put 100% commission on it and you're running your own validators, you're essentially taking that 12%. And then you can just dump that into the market, which is obviously horrible, because like, you're supposed to not make any money off of this investment, but you're making 12% of your investment, and like whatever the percentages change throughout the years, but should have never been a thing. I'm glad that they announced it. I guess like it's like an easy way to say that, to go against the FUD. Like Bearchain also had it, but they were a Cosmos-based chain. Like, they had stake tokens earned rewards, or locked tokens could be staked to earn rewards, is the right way to put it, I think.
Yeah, I mean, I don't have any crazy takes on this. I think effective sort of like marketing now for projects is to basically get ahead of these things. So to come out with a statement early and say that this won't be a thing, is just like, that's like a +1, like a job. And to not do it and maybe have to like address, that question mark someday in the future would be like a -1. So I think, shout out to Keone for getting ahead of it. Don't think it materially like changes anything for like, this was probably like a rough expectation for, most people going in to Monad. Like, I don't think it materially changed anything, but just, I think props to them at least for being early to it. I guess the only other thing I'll mention on Monad is they did announce as well their like early rewards program for from apps in the ecosystem. So there will be like some, points or tokens or what have you for interacting with. They've got like a cohort of like 12 or so apps from when mainnet goes live to earn rewards. So I think kind of a requirement as well. Like, not too surprising, right? I don't know if you disagree with that. Like, I don't know, Plasma rewards program, Barachain, early high incentives, Monad rewards program, incentives program. I think it's kind of an accepted thing that you have to do something to get some early capital in.
Yeah, I mean, or else you just immediately die out, right? You need to have you need to incentivize people. Just like off the top of my head, this Kizzy is, you wrote about all of these, Dan, so maybe like you'll have a better take. But like in my mind, I know that Kizzy is relatively interesting. I know that Kuru is relatively interesting. Two very different protocols, by the way. And I think that those two are the only ones I recognize. I know there's like Drake Exchange, right? That D is Drake Exchange, which is also a club.
Yeah. So Drake, one of the notable club or perp teams building there. Kuru, like the probably most notable DEX building on Monad. Kizzy, interesting just because it's like kind of like a gamified, like gambling on like views and like attention of like, social media markets almost. Like, how many views is a Mr. Beast video going to get? Things like that. Kind of like, I don't know. I think it fits into like sort of the Ryan Connor, net new assets kind of viewpoint, and maybe some are related to like a prediction markets kind of kind of trading app. Yeah. So similar to that type of thing. Some of the other ones I recognize as well, like they've got a few like Web3 like gaming projects, which, I mean, who knows? Maybe interesting, maybe not. That's been a really tough category in general forever. And some like Rare Bet Sports I recognize it as like a sports betting app. Not surprising. Like, I think a lot of the typical things you'd expect to see: gambling, trading apps, all the classics. So
what do you think about the Ryan Connor net new assets pieces? Maybe not year end, maybe like 6-8 months in. Should I give a background on what it is, or
maybe tee it up a little more.
So Ryan Connor net new assets pieces is that the crypto ecosystem is fundamentally going to change the way that assets are issued, and that we don't really need to care too much about, well, we should still care about real world assets, etc., but it's also about like creating new forms of asset issuance on chain. I think the ones that he mentioned were like one of the big ones was Believe, but I don't think he was like a huge fan of Believe. I think he was just more so a fan of like tokenized startups. And like prediction markets was obviously a big one. He also really liked creator stuff and content stuff. Yeah, I think that's probably good enough background.
Yeah, I think it's unsurprising to me that like, you can look at some of like the creator coins to date and like, maybe they're not like meaningfully doing anything. I guess what I would say is that like a lot of some of these categories are still basically just like meme coins, sort of lightly rebranded, and not really like, not quite like in the realm of being like totally new assets. So I think there's probably still some time to like iterate on that idea, because something I would say, like, while I don't think that like Pump Fun has like cracked some massively new revolutionized form of live streaming by putting a token on the stream, I do think there's something there in the realm of like a combination of like the financial incentives that go along with live streaming that hasn't like maybe quite been fully tapped into. Because you see creators on the other platforms that, you know, do interactive things with their chats, and like their chats can donate to them, they can send them money, and like that causes interactable things to happen on live streams. So, you know, maybe that doesn't really like, you know, just creating a meme coin maybe doesn't really like truly amplify or capture the value of that, but there might be another way to go about it, like a different type of asset that plays into that a little bit better. But yeah, I think kind of this like light masking of just like meme coins in a variety of different flavors is like maybe we're just like not quite there yet. But
yeah,
prediction markets is like maybe an interesting like net new asset in that we're seeing like different types of markets be traded that never would before. And I think we were kind of like maybe even as like a team we were a little bit too bearish on prediction markets like post election.
Yeah, I think so. I think we got too bearish. I mean, he was not bearish, and he was correct about that. With tokenized startups, I actually think like that version of what existed back then is not alive. Like Believe, the Flywheel, whatever is dead. But I mean, MetaDAO is essentially tokenized startups, right? It's like they call it ownership token. So like, if you think about it that way, that was correct. Prediction markets just caught me so by like such surprise. Now it seems super obvious, and it's like, oh yeah, well, these make so much sense, man. Like prediction markets are the future, but back then it was like, I don't know, maybe it was less like I saw kind of the utility of it, but it was more like just did not make a lot of sense to me as like a financial revenue generating product. I was just like who's gonna? And also like liquidity back then was very low. Volumes were very, very low, except for like the election, basically. And now we're seeing like, I guess distribution improved quite a bit in that. Like Kalshi is doing really well in volumes because of the Robinhood NFL partnership. Creator coins, I've been kind of turning to that idea. I don't want to talk too much about all of this stuff because we cover it essentially like once a month, but I've been seeing more and more like timeline bait of like pump fun stuff. And I think like that kind of stuff catches on really, really quickly, and because it gets really viral. Pump fun streamer doing stupid stuff. Like, you know, those guys on the microphones and they ask people questions like bother women and men and like college students, and they're like, oh, what do you do? This. I've been seeing more of those with Pump Fun, and I think those guys are making a lot of money through Pump Fun because you get the views, but you also get whatever trading fees. And I think part of the reason why I might miss this like thing catching on, and you might miss it as well. Do you watch any of those videos in real life? No, you see them on Twitter accidentally, and then you just scroll past them.
Like live streams, you mean?
Yeah, but like not like us. Everybody watches us, but like you know what I mean. Like the really cringe live streams that Zoomers do. You don't really watch those.
Oh, I see what you're saying. Yeah.
So I feel like I would miss out on that completely. But this idea of like people doing stuff for fame and making money on it, it's like no one's afraid to put their face and their name on the internet anymore. So they can just get as crazy as they want with it and become a content creator. And I don't know. I don't think it doesn't make. I think it didn't make any sense to me like a few months back. Now it's like it makes more and more sense. Don't know if Pump will be the one to capture it, but I also don't think it's like it's kind of like the worst thing that you can imagine in terms of like human psyche and like good for society ends up happening, and it might happen. There's nothing that says it won't happen.
Yeah. I go back and forth on this, and I'll say that like I don't know how this might shake out. I would be inclined to believe that like, you know, I mean, we've not seen any of these creator coins like not just effectively look like kind of pump and dump type of tokens because of how attention sort of works. Like it's the same as a lot of meme coins. Like they go viral for 1 week and then the price goes down, which isn't really like aligned with maybe the idea of like being a consistent live streamer and like maybe you give your audience exposure to like some asset that represents the growth of you as a creator or something along those lines. Like, I don't know. You'd have to. I think one, we would need to see like more of a transition from like a short term based outcome of these things to a longer term focused outcome. I'm not super convinced that like the average normie consumer cares to trade an asset that's associated with like Kai Cenat. I think they just like watching him because they are lonely and they're online all day, and they just like, you know, they connect with who he is, his generation, like, and the things he says. I'm not convinced that they like want to ape their $100 into his coin necessarily, but I could be wrong about that. But like, to me, I guess what I see in some of the traditional platforms is like people are already willing to just like give them money for free, basically. Like just raw donations to streamers is like an active part of the platforms today, and there's no monetary incentive back for them. It's just like purely capitalizing on users wanting to interact. I think is basically what, like, you know, people talk about parasocial relationships a lot, and I think that's kind of a piece of that puzzle. So I don't know if it's necessarily like this revolutionary platform is around like trading the assets associated with them, but if you can tap a little more deeply into like that interactivity and like, you know, take a piece of the dollars that flow through that, then there could be something there, because the existing platforms take huge cuts of, you know, like sub revenues and tip revenues and things like that, you know, 50% plus in some cases, for streamers. So not that just like you know, reducing your take rate is going to make you competitive. We've seen a lot of platforms try, even like stake with Kick, and it's not really working. So I don't know if that's enough, but I think if you can maybe drill into more about like why people interact with these streams and like make that better. I'm not sure if crypto is really the outlet to do that or not. Maybe open access to like different types of assets can play into it, but yeah, I'd say I'm firmly in the camp of like unsure to date, but I think it's like an interesting thing to play around in at least.
Yeah, I agree with that parasocial thing. I think people mostly do it so that people can read out their names, right?
Yeah,
or like,
or it'll make, you know, funny sounds, or like play noise, or like read out a text message on the screen or something. Yeah,
but I think Pump Fun does that. Like it shows like Danny Nettle bought $10 of ticker Boccaccio. Now, you know, I guess it just hasn't hit that much yet. I don't know. It's so difficult because I also don't understand people who tip streamers. Like I don't tip streamers. I don't even watch streamers. But if I did watch, I wouldn't tip them.
Yeah, I guess the point I'm making there is more so that like a lot of users already do it today in mass, and there's no financial incentive. So like, if the financial incentive isn't the reason that they do it today, like I don't know why that is going to be the reason that they'll do it tomorrow, unless there's something else there that I'm missing. But it could be a part of it if they can like tap more wholly into this like interactivity piece, which I think I mean, it's still a relatively new platform. They're like, I think overall behind in terms of like the broader kind of like streaming and like viewer tool set, if you want to call it that, or like feature set. But they could work towards that.
Yeah, I think. Yeah, I agree with you. I mean, they are quick. We're still super early, unironically. Danny, what do you want to talk about? Tempo or prediction trading terminals?
I mean, do you have thoughts on Tempo? This is it's outside my wheelhouse, I would say. I don't have a lot to say.
Very difficult to have like a super cohesive thought process on it because it's an L1 that runs ref that just announced a partnership with Commonwear, or like that they're working with Commonwear, which is like Patrick O'Grady's thing, ex Avalanche. But it's like all the knowledge we have right now is super infrastructure level, which I don't think is particularly important at this, like right now, given that Chain's not live. We don't know what's happening.
Yeah, I would frame the question as like, would you do anything differently today based on, you know, the news that we've received on Tempo's, you know, working with the Commonwealth or investing?
I would not. I think I would not. But there is this like, I guess that's like more so. I was more so thinking of like these guys announced massive partnerships, right? Like a very long list, something that It's like one of those ones that Hedera announces sometimes, and it's like 85 block like
Yeah.
companies. It's like, oh, like the IMF runs through us. Like, what the? But like this one is actually semi believable. Very big names. I guess like the thought process here is, what do you think is internally? We're working on neobank support. We've done some work on stablecoin chains. Where do you like? Do you have any strong opinions on either of those? Where you're like, because I think this is slightly out of your wheelhouse because you're an American, and I think you guys already have very existing ways to, like, you have Venmo and Cash App and very good online banking. I'm surprised that I guess like I'm wondering if you're at all interested in using either of these, like any of these platforms, the neobanks or the stablecoin chains, to do your daily banking, or is this something that is like completely out of the question for you?
I love stable coins and on-chain for like settlement purposes. So like, yeah, as a US resident, I have plenty of options to send money in between places with no fees and have it arrive in the other location, either instantly or like maybe same day or maybe like next day. Don't really have like problems moving money around or like having to pay egregious fees to do it in the first place. So it's not really like a huge pain point. But I do think, I don't know, like I actually had to send a wire like a week ago, or at least I thought I needed to send a wire, and then it turns out I didn't need to send a wire. But then I sat there, and it was supposed to be same day, but there was some number that was wrong on the receiving end of that wire. So then they had to revert it. And so then I actually had to wait like 7 days to see the money arrive back in my account. I had to wait a week to see money come back to my account, even though it never left and the transaction was reverted entirely. So I guess for some of those things, like, I'm excited to see like stablecoin on-chain transfers, like enable a more seamless, just like, okay, I have money here and I want to send it there. And I just would love for it to happen immediately. But like, I don't, this isn't like a huge pain point as a US user. Like for the most part, I can generally do that. Even like an ACH transfer, something like maybe you have to wait 2 days, if that.
So there's two things here. It's like, first of all, on the blockchain, if you had made that mistake, you would never get the money back. Well, I guess you didn't make a mistake. It was a mistake on their end, but
yeah, it was on
it
their
would
end.
have been completely cooked.
Yeah.
But yeah, like the US user doesn't make a lot of sense. But I think like I was thinking a lot about this with Plasma. And I think I don't even think it's particularly important for like emerging countries, who like I imagine will always use like sexes because it's just so easy to use, and it's very simple, and it has like built-in guardrails, and that shift will be very difficult. But there is this like new, I don't want to say class, but like there's this new like portion within like human society now that works online, gets paid in stablecoins, or makes money online, makes that through stablecoins. Like a lot of traders, people who yield farm. I don't know how significant of a demographic it is right now, but like the modern banking system, I don't think can really accommodate these people that well. Like especially nomads and stuff. Like you have to have bank accounts all across. Sending money from like country A to country B is difficult, but also proving that that money is yours is very, very difficult as well, especially if you're in crypto. Like I have a friend who withdrew money into Revolut, and they flagged it for months, like because he withdrew it from like on chain. I think he withdrew BTC or ETH, one of the two, and they flagged it. And that demographic isn't massive, and it's not as like sexy to say as like, oh, we're gonna bring the entire world on chain, or like we're gonna settle all of stablecoins, like all of finance using stablecoins. But it's still, I would say, like a meaningful amount of people. And these people, like, I would argue that the Venn diagram of like the people who spend most of the money on chain, excluding bots, who spend most of the money on chain, and like this portion of people is like probably as circular as you can get. Do you know what I mean? Like there's
Yeah.
that like small section. Like I said, I don't know how meaningful it is, but I think neobanks are probably like crypto neobanks will probably serve those users first. And then we'll see if they get further adoption after that from emerging markets. I don't really get the emerging market play that much. Coming from an emerging market, I know that it's very nice to be able to hold stable coins, but also people want to hold them on things that they know and they don't want to mess around with their money too much if they're not sophisticated users.
Yeah, I guess I've had this. I think I want to say I've had broadly the same view on this for a while, but I think in the US, the unlock for stablecoins is probably more of like on the business side, like the operational efficiencies or like almost like existing, red tape or like process arbitrage essentially. Like I can see this clearly for, businesses like Robinhood where it's like, okay, we'll facilitate some trades like in 24-hour markets and use, stable coins on the back end to kind of like handle payouts or process the payments, things along those lines. And I think that makes a lot of sense. And whereas like for the average consumer, it's like not super meaningful today. And then, but I do agree with you, like outside or like maybe from like more of a foreign perspective, I don't know, like just like general or like international perspective of like swapping between currencies. Like if I wanted to get some, pick your favorite currency, like pesos or yen or something right now. I'm not really sure what the best method, like maybe call my bank and like have them prepare it for me and I have to wait a week or two and like they're going to take a weird spread on it. Or if I'm lazy, I'll just show up at the airport, like the international airport, and like arrive in, a new country and like just get destroyed on the swap fee that they'll charge me at the desk. So
like 15% spread.
Exactly. Like you pay for them to like, bend you over there, which is there. It's like, I think there's some areas for like disruption of those, but it's a matter of like probably gradual adoption to the point where like there's enough meaningful liquidity in the markets to do that, as well as like, I don't know, some of these countries where like maybe there's still some use of physical cash versus, like digital payment, whether that means card or credit or whatever other, or crypto, it doesn't matter. Like if you go to Japan, like you can still like,
Yeah.
a lot of places want paper bills from you. And so it's like, okay, I'm going to need the physical currency. So just swapping it to yen on my phone isn't going to be enough. Like I need to then actually like get it from a machine. So I think there's kind of like a couple pieces of the process that have to get worked through.
Yeah, and it's not an easy puzzle to fix as well. Like it's quite a bit of stuff that needs to come together and work together very well. Yeah, that like money thing is exchanging money thing is a very big pain in the ass. I think anywhere, because nowhere really stocks paper notes anymore, and also nowhere really stocks foreign paper notes anymore. Like it's very difficult to get your hands on these things, so you have to ask them to bring it in. Essentially, best way to do it is for a bank, but it's also like very much a pain in the ass. So it would like, but the issue with on-chain is that there's no on-chain liquidity for anything but US dollars. Like even euros is, I mean, it exists, but it's not enough. And don't know if you really want to hold euros as well. Like there's no Swiss francs, right? Like I can pull up the Swiss franc chart, but like Swiss franc to US dollar chart's been up only. And maybe that's the currency you want to hold, and it's not really possible.
Yeah, there's like maybe a bull case there in that, in all of that for, sort of like an international payment processor to it, but it's somewhat dependent on, like you said, some of these like local regions to like move more to digital payments for like all services. Like you kind of, rely on that to some extent, but I think and it doesn't necessarily mean that they have to be doing crypto, but like, cause you have some of these cards now, right? It's like you can fill a debit card with your crypto balance. So I think just more and more of these like other regions maybe coming to, electronic payments and then bridging that gap from crypto to electronic payment, like can be pretty meaningful. But I do agree with you. Like, there's probably maybe some difficulty in establishing liquidity for like, Euro, Swiss francs on chain pools or like, yen peso pools. So we'll see.
It'll come, just not yet. Not for a while, I think, but it will come. I'm firmly of the belief that I think that like market that I talked about of like young, sophisticated digital nomads or people who make money through crypto or people who make money online some way or another is, I think it'll grow enough that, or it's like probably worth serving for 2 free protocols. I don't know how many can like make a lot of money off of it, and I don't know what the TAM is like exactly, because I think a lot of people just prefer traditional banking. Like I prefer traditional banking still, despite I would categorize myself as very crypto native. I still prefer traditional banking at this point. It's just it's a pain in the ass to do wires, but that's really like the worst thing about it, right?
You don't want to store all your money on chain, given the events of the past several weeks, and always have your cash yield farming.
I don't think I would ever yield. I mean, I think there needs to be like one, like there's very clearly like one big crypto app that needs to exist, which is that one that like allows you to swap from currency to currency and allows you to get access to bonds across the world, like government bonds, and like issued directly on. It doesn't have to be issued directly on chain, just like backed bonds, and that's it. And then maybe like you allow people to buy whatever, and like I would like Robinhood but fully on chain, and then I would use it. I already use Robinhood, but you get the point. Like then, and if it's like a big enough company that I know that like there's one that I've been using now a little bit. It's called Payy. I like load it up with a couple $100 and then like use it to buy groceries or buy coffee or whatever. And it's great, but I'm so stressed out to use it for anything larger because I'm like, what if the chain goes down? It's on Polygon. Like it's a Polygon L2 or it's related to Polygon somehow, but it also uses Celestia underneath. What if the chain goes down? Like I don't know who the developers are. Like they raised from good VCs. I think DBA and 6man did their round, but it's like things go wrong all the time. I mean, FTX raised from the best VCs and things went wrong. So, you know, things can get messy. And with a bank, I have insurance. So,
yep, agree.
we decided to do bank talk.
Yeah, they nobody on chain is doing FDIC insurance on my deposits yet, which is tough to compete against if you just want like your dollar to be $1 tomorrow. But there's plenty of yield degens. We see it over and over again. The yield degens will come out. They'll look for the nastiest, stinkiest yield on chain, and then they'll say the classic line: "If I full port into this, I can make $100,000 a year, and that's enough to retire."
That is, to be fair, that Stream DeFi thing, I wrote about it for the newsletter, but it's so funny because they gave this guy. Did you read about the story?
Yeah, just generally speaking, yeah.
They gave this guy money, and he was like managing some off-chain strategy using centralized exchanges, and then he got on his personal portfolio. He got liquidated on October 10th. And then he rate traded the whatever, I think it was $93 million or whatever. He bought a house and then he rate traded whatever was left. Let's say like $80 million. He rate traded it to try and make it all back, and then he lost it all. And then obviously Stream USD fell and struggled. I think we're going to talk about that with Matt and
we have to discuss it with the CMT guys. I think it's a pretty good one. I want to read this out just from this Yam account talking about the losses due to like sort of the vault interdependencies with all these like stable coins and different assets as part of that. But this classic line of like Treves SCUSD, Elite Rings SCUSD is backed by VUSD. VUSD is backed by Locked Stake SCUSD. Stake SCUSD is backed by Staked SCUSD. That specific SCUSD is rehypothecated to Mithras. Mithras SCUSD, about 92% equals 13 million, is currently borrowed by XUSD collateral on Silo and Euler. This is not an extensive list. There's likely more affected. Yeah, I don't know. We're getting some classic memes out of this of just like quite literally like I don't know. It gives very much 3AC vibes of like let's take the money and like go long and then loop it and then rehypothecate it and then do it in another asset and then like loop and rehypothecate it and do that like 6 times over to get like 13% yield on our stable coin.
Hello, Aryan. What is your take on? Did you hear what Danny said or
just
no?
toss him right in.
Straight into it. How are you guys?
Good. How are you?
Good. Glad to have you guys on.
Thank you for having us on.
Do you guys need to give a little disclaimer beforehand, or can we just dive in? I don't know, because people know you already. So, because you've been on the show before, so I'm just curious. Do you know what I'm talking about?
Yeah, we can dive in. The only disclaimer would be obviously these are all our thoughts. Nothing that we say is investment advice, and yeah, we're here purely to talk about the tech. But I'm excited.
Very good. We're also both very excited. I guess, Danny, I don't want you to have to give that.
Yeah. No, I can.
Over again because it
No. We just started talking about, I guess, the sort of whole fiasco in the past week or two with Stream DeFi and Elixir's DUSD and sort of like all of the rehypothecation and kind of like leverage looping and basically just trying to offer up like this yield product to people. These different vault products that are taking on risks that are kind of unknown to lenders in the pool. Curious, like if you have specific takes on like those protocols or just like generally like what's going on here and your thoughts.
Yeah, I'd love to comment just generally, and I know Matt will have thoughts on the specific protocols as well, but I think that reflexivity has been introduced into DeFi as a result of this. And that is affecting the way that ADL is interacting with these protocols. You know, ADL systems were designed for localized risk. And this sort of looping within DeFi across different protocols, especially what we saw with XUSD and Elixir, I think makes them systematic in the sense that ADL no longer can have a view on the broader scope of this risk. Because it's in this loop, then every Oracle update will trigger kind of identical liquidation behavior across all of DeFi. And I think that's where the problem comes in. And so it's not necessarily about eliminating ADL because it's no longer relevant, because I think it is still relevant, but it's about deciding where should ADL trigger and how should it trigger as a function of what. And I don't think that function should necessarily be contained to an individual protocol anymore. It should be more broad across all of the loops that are occurring.
I think the issue here too is that it may not even be an issue of ADL because we don't truly know where this hole exactly came from. There's been widespread speculation that it came from a trading group called Little Engine and a prop trader for Little Engine called Ryan. And we don't really truly know if this was a hole that was created as a form of ADL from the October 10th liquidity pull and subsequent blow up in the market, or if it's outright fraud. There's been accusations by the Stream team regarding Ryan from Little Engine taking funds from Stream and then using it to buy his own property. So it's really hard to know what exactly was the case here. But I think at the ultimate case is that there was this issue where the Stream team took capital users USDC, swapped it on CowSwap for Tether, used that to mint DE bridge that over to Avalanche to other markets, and then use markets on Avalanche to post the minted DE as collateral. And then they borrowed against that, took the staples, bridged it back to their own wallet, and then used that to mint XUSD. So is this highly, highly risky rehypothecation of assets at the end of the day. And I think this is like where like the true problem lied. There's a few problems, but one of the many mechanical ones in this trade that was a problem was that you're not just taking a looping strategy and having it sit idly within Aave earning yield and then borrowing and repeating the strategy through Pendle PTs or whatnot. you're minting it with leverage at the end of the day, which is why you saw, I think it was around $2 million worth of stables that became, I think it was 14.5 million of XUSD, which is a crazy amount of risk. And it was completely blurred by a total lack of proof of reserves, which I don't think we'll ever receive.
One thing here is I understand that this is not any protocol's fault, but is this the way that these modular lending protocols are meant to serve? Because it's like just somebody who took this vault, like who opened this vault permissionlessly and just decided to take too much risk. Like I agree that this, like what they did, I mean, just bridging over free chains with assets to me seems like, first of all, a pain in the ass, but second of all, like huge risk to take on. But is like, how do you guys, I guess like a better question here is, how do you guys see this form of modular lending develop going forward? If I can deposit into these vaults and I don't even know what's going on at the back end sometimes.
Yeah, so I have a few potential solutions. These aren't one size fits all solutions, and they may not be the best ones, but I think going forward, some that should be at least considered across the board. So I kind of break it down by three groups, right? The protocols, the curators, and then the market-wide ecosystem. On the protocol side, perhaps allow lists should be implemented where there's an allow list and a cap that forces exposure sizing. And I think time locks might be a good mechanism here too, to create this sort of observation window for market participants to observe how their deposits are being utilized and if they want to react or not. Another one too is that I've been thinking about is making oracles more liquidity aware and potentially adding some sort of ban trigger. So let's say that any of these sort of oracles that are being utilized within these more modular lending solutions like Euler and Morpho, where if there's like a enforced staleness bound where LTV ratios or borrow rates are tightened when a certain pegged asset or quote unquote pegged is deviating between its bands, then you freeze new borrows across other larger bands. I think it's worth noting on the Oracle side too that back in May, there was about $500,000 that was liquidated within the DE USD market because the Jared from Subway Mev bot swapped $200,000 of assets into DE USD in a buy on Curve, and that moved the market enough to liquidate 500K of collateral. And I think the end result from there was that they hard coded it 1-to-1. So I think that kind of has some yet to be seen from my perspective ramifications of what happened, but it is something that I've been taking a look at with historical context in mind. A few other things too that I think could be potentially helpful here would be a more dynamic supply borrow cap where they're sized with real liquidity to keep liquidation solvent and prevent these too large to liquidate positions from forming at a baseline. Could be something that could be more rigorously implemented on the protocol side. And then I think there's like a practical UX one too, is that have like a market badge with these vaults, right? Like tag them with badges that include like what they are: exogenous stable, fund of funds, not a stable coin. They just shouldn't ignore these exogenistic or recursive yield strategies, and people should be aware or at least see like what it is that they're depositing into before they click the deposit button. And I think that like a badge or like a toggle that shows what exactly they are would help market participants at least be a little more in tune with what exactly they're depositing into. On the curator side, like the big thing here is just like ban collateral lineage loops and set friendly caps. You gotta like out of this like situation, I think you gotta like be more tight around allocations where borrower collateral is directly or through a few different loop transactions it's financed by the same vault or sister vault interest strategy. I know you probably need like some sort of proof of reserve here, but I think that sort of like killing of collateral lineage should in fact kill this exact reflexivity blowout that happened with DEUSD and XUSD. And then on the ecosystem side, the last thing I want to say here is I think you got to standardize some sort of proof of backing signal for collateral eligibility. I understand the execution side's a bit difficult there, and there's been a few different solutions that haven't been exactly widely implemented, but it has to be something that you think about going forward, or at least at a minimum, like give curators the ability, and market participants too, the ability to have some sort of read-only API feed that can tell you what exactly these protocols are plugging into.
Yeah.
Sorry, I was just going to add to what Matt was saying. So we were talking about this internally. I sent a graphic that I want to talk about as well. So all of these are structured products, right? And we're moving towards more and more structured products. And I expect this not to slow down. I expect this to continue. Now, structured products, some of them are exogenously sourced from their yield, some of them are endogenously sourced. And I think this is where the reflexivity can begin. Now, Athena, in a way, is endogenous. Now, it's rebalancing by staying delta neutral on a continuous basis. And so it's removing the reflexivity through that piece. But I think this trade-off will continue, or this structural feature of these structured products is going to continue. And what's important is not necessarily gating permissionlessness with these products, but rating them. I mean, and that's what we're missing in this paradigm. And I think that's what Matt was alluding to as well. We're just missing coordination middleware that allows permissionlessness in these modules while maintaining safety. And I think that's as a result of a lack of transparency when you have so much rehypothecation and so many layers where this reflexivity loop through leverage expansion can actually take hold.
And here by that, Dan, I realized that we kind of threw you in the very, very deep end of this. So I
figured out what's going on. Pleasure to be here, gents. It's good to very clearly see who's the work from home crowd and who's in the office, but we love it.
Very, very good. So I guess like the main takeaway here is that we need to have some more form of transparency, and that you can see where the hell this money is flowing through, and you can see how much money there is involved in these strategies, as well as setting caps to it. I don't really understand how you can set caps to it, just given the fact that these are meant to be super permissionless. And I'm not very against this idea of allowing anybody to create a vault and then you can deposit into it. But I completely agree that the badge thing is a very obvious one. Another one is, I don't think if you're a modular lending protocol, you should host every vault on your front end. I don't think it makes any sense. Like, you should have 5 to 10 of them max, and like from curators that you trust, and then you just host them.
I mean, back there for sure.
Could this be an opportunity for eigenlayer? Is this something AVSs could do? What AVS is not? Couldn't they be risk registries, and they have different, tolerances?
Yeah, I mean, okay. So I hear the point. Like, one, broadly speaking, I think consumer protection is a good thing. The implementation details certainly matter there, and I think that's hard to do. But the weird thing about only listing certain vaults is then you are de facto giving those a stamp of approval that like they aren't risky, and that's like that is how the user will take it. And the other thing is like there are users that know they are taking risk and are very comfortable with doing that, and in fact want that product. They want the max levered loopage, knowing that days like this week can happen, but also knowing that if you're able to avoid that, you generate higher yields in the meantime. And so then you're just excommunicating that portion of the market segment. Now, that said, it's like, how do you sort of toe the line there and communicate the levels of risks in the vault is like the $1 zillion question, right? And the weird thing is like the people most qualified to have those opinions all have some like very meaningful conflict of interest in today's market, because the people who have the best experience are building in the space. They either are a curator or one of these protocols that provides this base layer infrastructure. So it's kind of like a weird thing. Now, I haven't looked deeply into this, but I just saw it earlier this morning, actually. But I think it's Credora who's starting to do some of this Let me try to pull up a tweet and I can shoot it over. But it seems like they're trying to take a first shot at, yeah, it is Credora by Redstone. Trying to give assessments and ratings to some of the, I don't know if it's on the vault specific or on the curator specific side of things, though.
I don't really understand the issue of having a strict list and an all list the way that Hyperliquid does, where it's like on strict you just show 10 and on all you show all of the different vaults. But yeah, I guess like if you don't include all of them, then you're kind of cooked.
Yeah, just like what does that say about the strict list, right? Like, I don't know. I'm sure you can find some dog shit that's listed in the strict list of perps products on Hyperliquid, right? That like just gets absolutely nuked, right? Like,
yeah, I think to Dan's point, like it depends on what the strict list is. Like, is this just like a, subjective, oh, we like this asset and therefore this one is on the strict list, or is there a clear list of criteria?
It's curators. It's based on curators. Like I imagine Gauntlet isn't doing super goofy stuff, right? Like they're just collecting their 2 and 20, or I don't know how the vault structures are, but
right. But what are the strict criteria to be on the strict list, or is it someone who's gone, oh well, I imagine that these guys aren't doing anything stupid, and then therefore they're on the, you know what I mean? There's a difference between a subjective and objective, and I think that's what Dan's getting at.
You're right.
But does that solve the problem? Because isn't Gauntlet? I mean, didn't they announce USDC and USDT freezing because of what happened, and that would have happened regardless of if there was a strict list or and not.
And curators can have, they can cover the risk spectrum. They can have the extremely risky vaults alongside the just USDC prime style vaults that are like, as vanilla as it gets. So I don't even think, I think it has to be vault specific.
In which case you have to do actual risk management and you have to do like proof of reserves, proof of backing. This was, go ahead.
Wasn't the Plume market that Elixir was borrowing from hidden from the UI? Like, to me, that just, and I think Elixir was the only depositor in there. It was like somewhere in like the 65, 70 mil range. And so to me, like maybe I'm tinfoil hatting this too hard, but I do wonder why that particular market was left off of the UI. I would assume that the curator was responsible for that. But to me, that just seemed like a hidden market where it was basically their little USDC money pit that they were using when they were bridging over to Plume to borrow on that market.
Maybe, but are we all agreed that modular lending is the way to go going forward? I don't do a lot of lending at all. We have specific guys who do lending on our team, like coverage. As far as I know, all of them are like fans of modular going forward, and they always say Aave is itself adopting modular lending platform, so it will be. What do you guys think?
As a big fund holder of Euler, I agree.
Right. Makes sense.
One thing that I do think is interesting on the risk side, and where I think we're going to talk about prediction markets as well and how to scale them. But I think one piece of how to scale prediction markets is turning it into a product that is consumed, like an Oracle. And let's say if you had a prediction market for whether or not some vault will fall to this, trap, and cause reflexivity in DeFi, that could be an input to that sort of risk engine. And I think that's a way that you could have an introduction of reflexivity within the data of what's informing the prediction market and what's informing that risk engine.
Do you think prediction markets are a good way to hedge exposure to like any form of financial exposure? Because we were talking about this with Danny, and after some deep egg occurred, I was like, do you guys remember Y2K? I don't know if you know it. It was kind of an obscure one, but kind of not as well, because I think it like launched at the bottom.
The one on Arbitrum?
Yeah, I think it had some significant flaws from what I remember, and it didn't last, obviously, but it's the only I guess that form of risk hedging that I can think ever launched and actually got some form of traction. So I'm wondering if prediction markets will fill that in, or if there's like just that coming back, but with a V2 or whatever, V3. I don't know how many times they tried to relaunch.
I think it could be prediction markets. I think it could also be HIP3.
How would that? Are we doing the AVS HIP3 talk? Is this what it is? Are you seeing it?
I mean, if there's a vault that's large enough and the risk is broad enough, I think it could make sense so long as you could actually structure it to be reflective of the risk and to actually be able to structure something that's delta neutral. I think the problem with a lot of the prediction markets is it's really hard to get true delta neutral in a continuous manner, and it just seems like if you were to structure a HIP3 market specifically for that purpose, it could be easier.
And by that you mean it's just the perp that you can short, or I guess you can long, whatever, like
right.
Stream Finance will fail. But
right.
Or the issue there is oracles.
Well, the underlying. So if Stream Finance was to fail, it would be XUSD or whatever the underlying token is that you would expect to fail.
Yeah. Stuff is fun, but it feels like we're getting into this dangerous level of financial engineering, which kind of stresses, because like hyperliquid, Jordy talked about this a few days back, and it's like hyperps are kind of flawed. They're very fun, like for pre-market, because you can, and it's like it's been their edge for a while. Like you can list day one and do really, really well, earn lots of fees as a protocol. But I mean, I think every single pre-market now has had that like massive Burj Khalifa where it like liquidates, because liquidity is so bad, and you can just come in with like $1 million, liquidate like 6,000 users, and then bring price back down to where it was. So I can't imagine. Daniel, you wanted to unmuted.
No, I didn't have any comment there. Sorry,
No.
I didn't unmute. That's on me.
So I don't know if it would work, Aryan. I apologize for saying it wouldn't work, but
no, for sure. It's just there's got to be more ways of being able to communicate what it is you want to represent, and I think that becomes increasingly important when we have increasing amounts of rehypothecation. It's kind of necessary work in terms of building a risk engine anyway. And so provided somebody does that, I think they would be the one best positioned to launch such a market. Now, is liquidity going to be an issue? I think it depends on if the structure is such that the protocol owns 60% of the token. If that's the case, then yeah, liquidity is always going to be an issue.
That makes sense.
All right. If we want to transition to something else, I'm going to take a brief moment of the stream's time to do a quick shout out to, where is my banner?
Fumbling.
I'm fumbling. Aptos. Bitcoin DeFi is heating up on Aptos with nearly 400 million in BTC assets on chain. Aptos users can now earn yield on their Bitcoin via Echo ABTC and OKX's XBTC without the typical bridge risks and high fees. Thanks again to Aptos for sponsoring today's stream. All right.
I realized I didn't ask Matt and Aryan if we can have sponsors on the stream because they're fun, but I guess we're gonna find out if it's okay or not after the live stream. Danny, what did you want to segue into?
Yeah, I guess if we don't have deeper thoughts on the prediction market thing, I guess I'm kind of aligned with you. There's like an open question mark there on like the liquidity piece of it. So it's sort of like a toss up. Would it work? Maybe. Would there be enough activity or liquidity? Maybe not. I don't know. Did you guys want to talk about, I'd be interested to talk maybe about some of these swapping models, like either if you want to go down the route of Euler swap in Fluid, or talk about like what Jupiter is doing with Ultra V3. Like curious, if you have more interest one way or the other, and kind of like what's exciting about some of these like new swap designs that are coming to market.
On-chain trading is a little bit more in my wheelhouse personally. And I think the Jupiter side of things is actually quite interesting. So if you want to open it with V3, maybe we can run that direction.
I have a question about Solana's hit. It's a little controversial. Is that okay?
We love
Daniel,
controversy.
with regard to Titan, I've been told that the flow that they're getting is not real to the extent that they believe.
Okay, what you got to unpack that? What do you mean not real?
Well, they're kind of faking their flow a bit.
You gotta keep going. Say what you want to say.
They're cooking the books. D-Flow, Jupiter, and Titan are competing, and from what I've understood is that Titan is to an extent showing that their pricing is better than competitors, and then the end user actually does not get that good price. It just gets the worst price, in fact.
Okay, so those are kind of two slightly different things. But to the second piece, and we'll come back to the first piece. So let's see. They might have actually taken that exact thing off, which is fairly interesting. So what they were doing was basically simulating quotes. Like it was like considered just like an ad box on their website. Like they still do it. All right, let me share screen. This actually shows my wallet address, so never mind.
That's okay. That's fine.
And I have to connect to open it.
Share with the class, actually.
So what they were doing is basically when the classic swap UI, right below that, they would basically say, here's the price that you would get on Jupiter, Titan, or like our price and D-Flow. But the way that they simulate those prices matters a lot in terms of like what the number that shows. So D-Flow and Jupiter had both made public comments around, that just not being the route that you would get if you used either of their UIs. I think in the case of Jupiter, they were using like a very old binary that was like publicly available. It was like Jupiter V1. Jupiter's on like V6 now of their product. And so I think that was sort of their main contention. And I don't actually know the specifics of the D-Flow side, but their team was pretty public about like the fact that that was a disingenuous representation of the price you would get for that same swap on their application at the same time. I get why Titan did it. I get why D-Flow and Jupiter are upset about that marketing. And the reality is like who's going to get the best price today, and it's like very hard to simulate and replicate those exact things, right? Because even if you look at trades for the same pairs within the same blocks, the sequencing of like when the user pressed submit is going to impact the price that they received quite a bit. There's also other variables like slippage and how the transaction made its way from the RPC to the leader. Like there's a million things at play. So it's actually quite a hard challenge to really dig into. What you can definitely be assured of is it is a fiercely competitive market. And what the end result of that is users are probably getting the best execution they've ever gotten because of that, right? On Solana is a little bit of an outlier in the sense that a vast majority of trading volume from a user flow perspective actually moves through aggregators rather than DEX front ends or trading products as a whole. Whereas like on EVM networks, I think there's a lot of path dependency here, but Uniswap sat very core to trading for so long. It was where on-chain trading essentially originated. And therefore the front end was actually kind of like that main source of flow. And then moving on to the L2s, like there are absolutely aggregator products, 1inch, 0x, they have like Matcha as a popular product. And there's many others. It's interesting. Like when you look at the data and compare like percentage of volume from aggregators as a percentage of total DEX trading volume, there's just like massively different numbers, which is fascinating. So I guess to like concretely answer your second question, the Jupiter and D-Flow felt like there was a misrepresentation of the actual quote you would get on their products, and Titan was kind of using this as a marketing angle. I am, again, just looking at their product now. It actually looks like they took that piece off. Yeah, and I think all three of them are great products. Like I've used all three. Jupiter is kind of just like in my workflow, is because I've been using it first, and I don't know. Whenever I open Phantom, like I find myself still typing in jupe.ag. It's just like habit. That's kind of like, the benefit of being a first mover advantage here. Again, I use all three. I've explored with all three, but that's just like where I'm at today. And on the faking the flow piece is actually a super interesting question. So then I'll just go show some stats here and then wind down my rant for you. So let me go ahead and share screen, which always is a battle for me as a human. But the faking the flow thing is like, it's an interesting question to answer because like, how do you really define that? And like, what does that actually mean? There's two interesting things. Sorry, I think you got to just throw it up on the stage, but then
I got to do it. There we go.
Cool. Awesome. So this is our publicly available Solana DEX aggregator dashboard. It's on the Solana section of our public page on the blockworks.co website. But a couple of things to look here is like, one, historically looking at volumes, it's been a Jupiter show, obviously, until somewhat recently, right? Since about May of 25 this year, we started to see that get shaken up a little bit with both OKX, DFlow, and Titan all coming online and being kind of showing their force, and more recently, Titan and DFlow actually being a material percentage of competition. A couple interesting trends here. So you can identify cyclic arbitrage fairly easily, or atomic arbitrage fairly easily on a DEX aggregator. And specifically when it comes to cyclic arbitrage, what we mean there specifically is it's atomic arbitrage where the input token is the same as the output token, right? So like the swap will literally read the user trades USDC for USDC, and if they put in 100, they get out 101 because you're basically routing through all these different AMMs that the aggregators are connected to, and that is creating these atomic arbitrage opportunities. So we can get into the why this has changed a lot recently in the presence of prop AMMs. But you can see like there's a significant amount of arbitrage volume that flows over these DEX aggregators, which historically, I've been very focused around like that's where the user goes to get the best price, which is kind of an interesting change in sort of the market structure. And it's also additional evidence that the prices that you're getting on aggregators today are very good prices, such that arbitrage opportunities are actually that's sort of a great way to capture them is over these aggregators. So even just like on a percentage basis, this cyclic arbitrage is about 40 to 50% of all volume that moves over DEX aggregators. So that is kind of an interesting angle to answer your question. Like, are they faking volume? Like, no, but like, is there a hot ball of money that is looking for these arbitrage opportunities that is hitting these these DEX aggregators? 100%. Now, I don't view that as fake volume. I don't treat that as fake volume. Like, I don't agree with that framing, but it is objectively different than like retail flow. That's a little bit harder to measure, and you need a little bit more of an address heuristic methodology that we're certainly exploring. It's something that gets us super excited.
Aryan, you said you wanted
Euler swap. Yes, you asked, what we think is interesting. I think Euler swap is interesting because if we look at most systems, Aave, Compound, credit as it's existed before, credit and liquidity exist in these separate silos. Lenders provide capital, traders are moving it around. But Euler swap is fusing this. It's kind of making the same collateral base support both the borrowing capacity and the market depth. And I think this does a few things, because modularity normally is about separation, and each risk engine covers its own kind of pool, and those pools are separate across both functions. But in this is aggregating the liquidity, and it's recoupling those functions. And in doing so, it's internalizing feedback loops, which I think has an effect on reflexivity. Because when swap depth and lending utilization are independent, liquidity is pro-cyclical. And when they're coupled, it's more reflective on each other. Utilization spikes, the swap depth will tighten, the rates will rise, and the collateral demand will fall. And so utilization drops, and it becomes kind of self-correcting in this way. And I think what's interesting about Euler swap is it's effectively testing whether that reflexivity can be designed into the liquidity itself, not just protected against it. And I think that's interesting. There's obviously considerations, you can't risk isolation is very difficult here now, and you have to assume that reflexivity angle will protect against it, and you can always have, I guess, unified math model instead of several governance layers, but time will tell if that's enough. But I think it's a step in the right direction, because it is providing the benefits of modularity without the broadening the risk considerations.
Thoughts on it are that just to give a couple of my own thoughts just on Euler swap and a few other these lending field swapping mechanisms that have come to market over the past couple of months, is that I do agree with Aryan and do think that JIT borrowing creates conceptually more meaningful, deeper liquidity per dollar of TVL with slippage versus static LP reserves. And because these deposits are earning an effective yield on the lending side with swap fees simultaneously, LPs should, in theory, need fewer external incentives to stay. And so this creates this sort of flywheel where there should be more durable liquidity without these, highly mercenistic emissions, which we kind of seen come up with, a few different of the V3 pools on Uniswap to date. I think like the consideration to kind of like look out for, like with the vault utilization, is that when vaults are kind of like near that like max utilization level, or caps are tight, I think JIT borrow headroom kind of comes off a bit, with highly volatile pairs too, with conservative LTVs. So like leverageable debt, is quite a bit smaller. And so we're seeing like a lot of activity historically along the lines of like stable pairs like USDT, USDC, which I think by and large is the largest pair that we've seen swapped out of Euler swap, if I'm not mistaken. And we've kind of seen like stable to stable swaps become hyper efficient too. Bunny was doing stuff with this with V4 before they were exploited. I think Akubo is doing some really cool stuff on their stable to stable swaps, but I guess my like primary point of contention here is that like this is all very cool tech and it's all becoming more efficient, but in terms of like token utility, I think that's a bit of a black hole that is yet to be discussed or resolved.
What did you say the pair was that drives the most volume?
I think it's USDT, USDC, but I could be mistaken.
Okay, so it's definitely on the stable side. Interesting.
Yes. Yeah.
There's
one thing.
Go ahead, Buck.
One thing, like I've been. So if USDC, USDT is the most popular pool, to me, I feel like Solana has done a kind of a different approach to these majors and to these like very liquid assets, which is the prop AMM. And it's worked very well for them so far. Or the RFQ system is also very popular. They haven't been able to figure out CLOBs very well yet, so it hasn't happened. I assume on the EVM, at least on the relatively popular ones today, CLOBs won't be a thing for some time. Euler swap is, unfortunately, I think a lot of these lending protocols kind of struggle from what you mentioned, Matt, which is the token thing. But like the second thing here is, I feel like there's like feels a bit complicated, and I'm almost like wondering if an RFQ system is a bit better for this as opposed to Euler swap. You know what I mean? Like I hate being that guy that always like, because this is like happened to me a lot in Blockworks research where someone's like, oh, like this new AMM structure is going on. Like, you know what? Like we could probably just have a market maker fill these quotes for like, it's way less, like way more capital efficient, not as complicated. And since everybody's interacting through aggregators, on the other hand, I do like this idea of, well, actually, I don't know if I love it. Like lending being used for swaps also gets, I don't know. You guys, the thing is that I'm disagreeing here, but also you guys are like 2 standard deviations above me. So I'm kind of disagreeing hesitantly and thinking if I shouldn't be disagreeing. But do you get like the gist of what
I have an add-on? Yeah, I have an add-on and maybe a simplifier to Box's question, is because my head was in the same spot. But like, do we think there's like a path dependency and maybe just like the state of trading activity on like ETH versus Solana that's led to, something like Fluid taking off on Ethereum, whereas prop AMMs have come to like fill that niche for, to sort of like fill orders that are being placed on the aggregators? Or is there something else going on here? Like, would we expect at some point in the future that they all trend to the same endpoint, or no?
There's a lot of good questions there. I think I wouldn't say Euler swap is necessarily purely an AMM. I I know it looks like that in terms of design, but I think it's credit-aware liquidity in that sense. It's not just that liquidity is posted and credit exposure is zero. It's the same collateral is used for borrowing as well, and so you get more. And I think the main reason that they've structured it like this is it would be so difficult to have an RFQ system that has composability as broadly as something like Euler Swap would or an AMM would. And I think when you're thinking about modular lending and credit in general, that composability is really important for distribution and kind of scaling. Now, on the actual AMM design and whether or not that should tend towards an RFQ in the future, I think it's interesting. I do think that they would lose some of the self-correcting mechanisms that exist with the curve on the credit utilization piece.
How do you think, like, what is like the best case scenario for Euler Swap look like? Like when you think about a year from now and it just like has smashing success over the next 12 months, like what is it doing that is like what market problem is it solving today? Is it on the yield? Like, is it giving users an ability to just generate yield in an interesting way? Or is it more so like trying to solve a specific gap in the lending or trading side of things?
Can I make my guess and then you can give the correct answer, Arjen? I think it's specifically there's a lot of this capital that isn't being used efficiently and it just needs to be put out there and acted. Like I do understand this point of like making this liquidity available to an extent, because then RFQers can, like market makers can use that liquidity somehow for their own functions as well, right? Now, please give the actual answer, Arjen.
No, I think that's right. And Matt probably has a better answer than me here, to be honest. I think it's credit-aware liquidity, where a system where it's really allocating to, it's somewhat underwriting, and it's not underwriting explicitly. It's kind of as a function of the credit piece, but it's most efficiently using liquidity with credit in mind, and so swaps are credit operations in that case, and as a result of that, you would have composable credit markets emerging, and then we would assume programmatic access to credit.
It's that liquidity. It's using Euler Swap to bootstrap liquidity originally, which saves on incentives, which I previously alluded to. I think a year from now, one of the success factors that I would be looking at would be our DAO treasuries and protocols seeding their pools from day one on Euler Swap without having to stream in the native token to LPs, which we have seen in the past creates a bit of selling pressure for DEX seeded pools out of the gate. And obviously saves treasury managed funds on the native token side as well. Some other things too. Obviously, you want deeper effective liquidity across the board. You want liquidity reused and reduced fragmentation, because LP funds are in lending vaults and can be reused around pool. Hopefully that solves this liquidity fragmentation problem, or at least reduces it to an extent, as it's a fairly large issue right now. And then on the trader experience and routing integration side, there's hopefully going to be this reflexive loop where, since they support V4 hooks and it's integrated into existing routing frameworks, traders will inherently benefit from a more competitive execution side without needing to know on the back end that the capital they're swapping in and out of is being lit and used in JIT borrowing simultaneously.
And it's deployed. I mean, since it's built on Unity v4, I assume it's pretty deployed on like the top chains and whatnot. Because when the DAO treasury piece is interesting, and whenever I think of like, all right, which DAO's got the money to make that apply for that RFP for, it's like Arbitrum always comes to mind, because they do have a lot of resources, DAO managed resources. I'm curious if like how the broader DAO treasury integration side of things is going.
In terms of using that capital?
Yeah, exactly.
Yeah, I mean, it's kind of in line with our best case scenario, right? It's not that Euler Swap would compete with someone like Uniswap, but would change the term of liquidity provision to credit extension. And in a way, you're looking at how balance sheets work in traditional finance. And I think the movement towards that is the opportunity for order swap. And that should absolutely apply to DAO treasuries, which are probably the largest case of idle liquidity in DeFi.
Okay, so Euler swap, prediction markets, Jupiter we're excited about. Arya and Matt, before we
That's it.
probably wrap things up, do we have anything else that you guys are like super looking forward to over the next year?
Just deploying out of our recently announced Fund 4. We are very excited for that fund. We've backed a few exciting opportunities that I'm not sure if we can comment on just yet, but I'm sure you'll see Twitter announcements in the coming months. We're really excited for that particular fund. We continue to source and find really exciting deals within the space and backing founders who we believe are furthering the adoption curve within crypto, and continue to try to find amazing founders to back. And we're really excited going forward.
I generally I'm excited about. So there's a lot of like infrastructure pieces that we could talk about. I could talk about like the networking stack kind of becoming crypto native, and the work that people like 0xResearch and Optimum are doing there. But broadly, there's one thing that I'm really excited about, and I'm really going to be looking for in Fund 4, which is piggybacking as distribution. You know, using existing frameworks, whether that's in TradFi or whether that's on the personal consumer application side of things, and the data that is associated with that. I really like the idea of piggybacking off of existing standards as a method of onboarding to crypto. And I think that's something that I'm expecting to explode in popularity this year.
What about store of value assets that pivoted to roulette with a take where the take is burned? Interesting or not?
We'll take the whole round.
Yeah. I saw the annualized number. I'm in.
All right, there we go. That's when you know annualizing 1 day revenues. That's like 2020, like that. Okay, so we've got annualizing 1 day revenues. We've got Dino Coins putting in multiple 40% days sequentially. I don't know. This is like a very strange 2-week period in the market where like, yeah, like, I don't know, Bitcoin fell from 115 back to 98, 97. And yet you still have these like very on-chain pockets of, relative nonsense going down where it's like exciting things happening. I don't know. It's a really fun time. Like if you're rocking the ZEC stack, there is no bear market. You're crushing all-time highs in every category there. And if you're just like the Bitcoin, ETH, Solana stack, you hate life. So it's like a very strange dichotomy of what's happening in markets right now. I don't know if I was late to the party. I don't know if we missed this bit, but I'm curious on the takes here.
You can tell what assets Dan is long by how enthusiastic he was in stating that.
Has Dan given you guys his 2-week notice yet?
He has not, but we're expecting it over the next week.
I'm a lifer. There's no 2-week notice coming.
You know the top is in when he, instead of the 1 day annualized, he's doing the 1 block annualized, and it's like the top block of the entire casino.
No, I was looking at give me a second.
The child has distracted us from ZEC talk. The thing is, I can't talk about Zcash because I should definitely not say it in front of the child, so we'll wait. All right, Danny, you want to rule us out? Rule us out. You want to wrap us out?
I would love to do one more thing. I would love to give a shout out to our sponsor for today's stream, Aptos. With nearly 400 million in BTC assets on chain, supported by a secure, fast, and affordable MBM environment, Aptos has become the BTCFi growth chain. Aptos users can now earn yield on their Bitcoin via Echo's ABTC and OKX's XBTC without the typical bridge risks and high fees. With support from Echo, OKX, and Stacks' SBTC, Aptos is the place to go for best-in-class yield on your Bitcoin. Appreciate the support as always, Aptos. Thanks so much for the sponsor.
They're on point with that ad. Get spot assets on your chain. That's like P1, P0. Make it happen.
What are you doing? Are you
What?
shitting on the sponsor live?
No, I said they're on.
He said they're right.
Oh, okay. I was like, they're not doing the right thing. I was like, don't do that.
No.
They have it.
Totally the
They're
opposite.
talking about it.
Totally the opposite. Like that is totally the right move. You got like Hyperliquid's doing this. Mert has been on a rampage about bringing Zek onto Solana, and then it actually worked.
Is that where all the near intents are coming from, by the way? Is it literally just people buying Zcash?
I love on-chain data more than 99.9% of people. I hate bridging data. So don't ask me. Get to me on the pod.
Don't you have a bunch of juniors that can take care of this? Like, hey, look through.
You got a whole team, Dan.
Put anybody into that death pit of an arena.
We have one guy who we just give the word. Well, not me. I'm not involved in the data. They won't let me touch any form of data or chart. But we have a guy I know they give like all of the like very difficult blockchains to. Rod, shout out Rod. So Dan, maybe this is a job for Rod. No?
Rod's the Aptos goat too. Shout out to the sponsor.
Very good. All right, Danny. I think we can.
All right, we can call it there. I'll shout out the for whatever reason, Mert and the Solana crew have been nailing these home runs that are not the Sol token, but they've been nailing Zek and now Near, interestingly. So something of a track record they've been building there. Arian, Matt, thanks so much for coming on today. Appreciate having you guys on. We'll have to have you guys on again in the future to get in more detail. I know we maybe didn't get to dive in as much as we know you love to. But to everyone out there watching, appreciate y'all tuning in, and hopefully you're not Or-lined or Zek-lined, I guess.
Thank you for having us.
Appreciate the time, guys. Always a pleasure.
Always a pleasure.
Thanks, guys. We'll see y'all next week.
Happy Friday.
Happy Friday.
Enjoy your weekends.
We need to end it.
Why did you?
Dan Smith, stay on.